Government securities market. Virtually all governments around the world finance their national debt and government deficit by issuing long-term bonds. These are known by different names in different countries but generically referred to as G-Sec. In the US context, for example, T-notes or treasury notes refer to bonds of 1 to 10 years maturity, and T-bonds refer to bonds of more than 10 years maturity issued by the government of the United States. In some countries, long-term bonds issued by the government are referred to as gilt-edged securities or simply gilts. The name gilts stems from the fact that the government, who is the issuer of gilts, would be the only risk-free entity in that country, and hence the probability of default would be 0. The nomenclature to uniquely identify a G-Sec comprises of 3 parts: the year of maturity of the G-Sec, a unique country mnemonic to identify the issuing government, and the coupon rate applicable to that G-Sec. For example, a G-Sec issued by the government of Utopia, maturing in the year 2030, carrying a coupon rate of 8.25% could be identified as 2030 GOU 8.25, and this is how it would be quoted in the Reuters screens and Bloomberg screens and so on and so forth. G-Sec, such as T-notes and T-bonds, are bought and sold very actively in the secondary market. The market quotation on a Reuters screen, for example, shows a bid price, which is the price at which bond dealers are willing to buy a specific G-Sec, and an ask price is the price at which the bond dealers are willing to sell that specific G-Sec. The ask yield, on the other hand, is that yield to maturity which equates the ask price of the security to the present value of the future coupon payments plus the face value of the security payable at maturity. Let's explain this with an example. If a G-Sec of face value 100 and coupon rate of 8% with residual maturity of 5 years is currently trading at an ask price of 102.50, then the ask yield as shown by the computation in the spreadsheet that you are looking at now will be 7.385%. So on the screen, in your Reuters screen, you would see the ask yield as 7.385%. And oftentimes, the bond itself is quoted based on that yield to maturity. This is in line with the bond pricing theorem we have learnt in an earlier session. If you've forgotten, please look up yield, YTM, and bond pricing. It may be appropriate to mention here that the yield on G-Sec, which are long-term in nature, would almost always be higher than the yield on short-term T-bills. This again is in line with the term structure of interest rates that we have looked at in an earlier session. In case you've forgotten, go back and look up term structure of interest rates. Also remember, yields on short-term T-bills would be relatively more volatile than the yields on G-Secs simply because the impact of inflation and money supply on short-term interest rates would be far higher than on long-term interest rates. There are 2 very innovative variants to the time-tested G-Sec instruments. One is called STRIPS, which stands for Separate Trading of Registered Interest and Principal Securities, and the second is Inflation Indexed Bonds. Let's look at STRIPS first. STRIPS is a security in which the face value of the bond payable on maturity is separated out from the periodic coupon payments, and the periodic coupon payments are separated from each other. Let's construct the strips for a 10-year G-Sec that has an annual coupon of 7%, face value 10,000 currency units, and prevailing YTM 6.85%. These are the interest cash flows for 10 years at a coupon rate of 7%, and this is the principal cash flow at the end of 10 years. Given the YTM of 6.85, the present value of the above cash flows are shown in this column. Let's interpret these cash flows and their present value in the context of strips. The first year cash flow would imply a 1-year zero coupon bond, that is, pay 655.12 now and receive 700 1 year later. And the last cash flow in the table would imply a 10-year zero coupon bond, that is, pay 5155.31 now and receive 10,000 10 years later. The same interpretations would apply to the other cash flows in the table. As you can see from the spreadsheet, each component of the strip can be treated and hence traded like a zero coupon bond. Hence, strips are attractive investments to those investors who have specific investment goals and needs. For instance, an insurance company that is required to pay a guaranteed lump sum of money when the holder reaches retirement age, say 10 years from now, would find the investment in the principal strip very attractive. Similarly, a pension fund which is required to pay a fixed sum of money at pre-specified time periods to meet its pension payment obligations would find the interest strips very attractive. It may be appropriate to mention here that strips are never issued by the government. Instead, large brokerage houses buy the G-Secs auctioned by the government, create the strip components and sell them separately. In the next video, we will look at the other variants of the G-Sec instrument.